Ah!
In 2020, a widespread pandemic has shocked the global economy. Countries go into lockdown. $3 trillion lost in GDP, and the world step in short recession after first half of negative growth. But are we on the verge of another financial crisis? Looking back, at 13 years ago, the collapse of Lehman Brothers became the signal of an unforgettable event. The day after Lehman Brothers filed for bankruptcy, September 15, 2008. The Fed had to hand a bailout of $150 billion for the banking system. A few weeks later, Congress passed the Troubled Asset Relief Program, which allocated another $700 billion to save the economy. But the Lehman fall still caused inevitable $10 trillion lost in global economic output. Restart at the beginning of 2000s, we know that the main reason came after the impact of dot-com bubble. The Fed have to continuously lower its benchmark interest rate to encourage lending practices and revive US economy. This is when the underlying problem arises: US mortgage become more and more attractive with lower borrowing rate. During 2000 to 2003, housing loan from bank increased 3 times fold, aligned with the decline of Fed rate. Easy lending in this segment has incentivized banks like Lehman Brothers and other financial firms to finance for a group of loan that we later known as subprime mortgages. The significant drop in Fed rate also pushed US economy in overheat state, with a record of 8% growth in 2003 quarterly GDP. In 2004, the Fed soon realized their mistake in letting policy rate become too easy, quickly adjust up the benchmark rate to reduce the economic risk. This is when debatable opinion arises. Although, the purpose of hawking rate after 2004 is to cease the overheated economy and draw people away from risky loans. It has indirectly causing too much pressure for homeowners, as they are hard hit with rising borrowing cost and lower income, due to slower economic growth in a short period. Rising rate also mean higher yield for financial asset, pulled people money out of manufacturing into stock, bonds, and some of the important contributor to the crisis, mortgage-backed security, MBS. In short explanation, mortgage-backed security gathers hundreds of the home loans into a tradable security for investors. It creates a way to trade multiple mortgage based on so-called investor value. And, despite of Alan Greenspan warning in the housing market, price of this security was pushed up sky high, giving much paper return for its investor. In the later research paper of Fed, it shows up that housing finance companies like Fannie Mae and Freddie Mac, investment bank like Lehman Brothers and other hedge funds, are the biggest buyers of this financial product. Wobble in the investment asset, and systematic default in the bank loan, eventually caused the inevitable financial crisis. After the powerful green dollar broke down, other countries also suffered from mass withdrawal of global foreign investment in the later years.